right now, there is a quantitative algorithm scraping the internet, and it's tracking the exact vocabulary of Federal Reserve Chairman Kevin Warsh, like literally betting millions of dollars on whether he says the specific word shock at a press conference.
Yeah, and it sounds like a joke, but it's a completely real financial wager. And it's happening because, honestly, the physical economy is experiencing such massive turbulence right now that the traditional financial plumbing is just contorting itself into shapes we haven't seen before.
Right, because if you look at, say, the cost of shipping a $10 t-shirt across the Pacific, or, the cost of heating a home in Northern Ireland, both of those things just fundamentally broke this month. So in our look into the sources today, we are pulling apart this new structural reality of international trade.
Exactly, because these aren't just abstract concepts. We are looking at how energy shocks are turning central banking into a literal prediction market, and how the tech sector is basically funding the AI boom with this giant circular economy.
And we're also going to explore how everyday retail investors are getting 24-hour leverage access to the markets. I mean, these mechanisms might sound like dense Wall Street jargon, but they dictate everything from the price of the items in your shopping cart to how your retirement portfolio behaves.
The rules governing how money moves and who gets to trade have shifted really aggressively over the past 12 months. What we're witnessing is not just a temporary market fluctuation. The underlying architecture, the legal clauses, the margin requirements, the supply of available shares that is what's actively dictating economic outcomes right now.
And the most immediate place that you as a consumer are going to feel this architectural shift is right at the checkout screen. So, on Friday, July 24th, the U.S. government completely swapped out the foundation of its trade policy. We replaced a bunch of temporary tariffs with a permanent wave, ranging from 10 to 12.5%, hitting 60 different trading partners.
Right. And what's fascinating is the market reaction, or really the lack of one. Investors didn't panic. They basically treated it as a new baseline reality, not a political stunt that might just blow over.
Which tells me they saw this coming. But why treat it as so permanent? Because, previous rounds of tariffs were always getting challenged in court or delayed.
Well, it's because of the specific legal mechanism they deployed this time. This new onslaught is built directly on Section 301 of the Trade Act of 1974. And that framework grants the executive branch this incredibly broad unilateral authority to penalize foreign trade practices.
Oh, so they don't even need congressional approval or standard judicial review for this.
Exactly. That takes the dispute completely out of the traditional court system. The legal escape hatch for importers is just firmly shut. So the market sees this as a lasting structural drag on global retail.
That makes sense. But as massive as those permanent tariffs are, the actual earthquake for retail pricing really began last year, right? In August of 2025, when the U.S. eliminated the de minimis exemption, and the financial fallout from that is just now hitting corporate balance sheets, and the numbers are brutal.
Yeah, to really grasp the damage there, you have to understand the logistics of how that loophole functioned for so long. The de minimis exemption basically allowed packages valued under $800 to enter the U.S. completely duty-free.
Whereas a traditional retailer, bringing in goods on massive container ships, they get assessed at the port, and the total value of that container gets taxed.
Right, but modern fast fashion e-commerce empires, they engineered their entire network to bypass that.
Yeah.
They shipped millions of individual low-value parcels directly from overseas factories to your front door. Every single one of those packages bypassed customs duties entirely.
It's like a wildly popular nightclub operating without a cover charge. The party was huge, the line was around the block, everyone built their business models around free entry. But then, the bouncer shows up, the rules change, and suddenly everyone has to pay $20 at the door. The companies that relied on that free entry are just collapsing.
They really are. Look at the fast fashion giant Shein. They just released their first quarter figures, and they swung to a $99 million loss.
Which is wild because a year earlier, when they were still operating under that de minimis loophole, they posted a $395 million profit in that same exact quarter.
Yeah, that is a nearly $500 million swing into the red. And it's driven entirely by paperwork at the border.
But wait, did consumer demand for Shein just drop off a cliff, or is it literally just the taxes?
It's just the taxes. The demand did not vanish at all. Up to March 2026, Shein had 281 million active customers, placing over 1 billion orders. People still want the clothes. But the removal of that loophole fundamentally broke their logistics math.
Because they can't absorb those new border taxes on individual parcels without raising prices, and their entire brand identity is ultra low prices. And this isn't just a U.S. phenomenon, is it?
No, it's global friction. The European Union recently imposed a new levy of about $3.40 on low-value e-commerce imports, and that was specifically designed to attack this exact same parcel shipping strategy.
Which introduces this fantastic irony into the retail landscape. You've got this futuristic, digitally native behemoth with no physical real estate bleeding cash. Meanwhile, traditional brick-and-mortar retailers are actually successfully fighting back, like Primark in the UK.
Right, Primark operates over 190 physical stores. They pay massive commercial rent. They employ thousands of floor staff. But they're fighting back using a classic supermarket tactic.
You mean loss leaders, like slashing prices on basic items to lure people in.
Exactly. A grocery store will sell, milk or bananas at a loss to get you through the doors. They calculate that once you're inside, you'll impulsively buy a high-margin box of cereal. Primark is doing that with basic apparel, like jeans and jumpers, to break the digital shopping habit and pull people away from Shein and Temu.
So the physical mall brand is weaponizing its storefronts like a discount grocery store, while the algorithmically optimized digital platform is drowning in customs taxes. That is wild. It really shows the era of frictionless, untaxed global consumption is over.
It is. But, border taxes are only one form of friction. There's a much more volatile disruption happening right now in the physical economy, and it's being driven by actual military conflict in the energy markets.
Right, shifting from the cost of clothes to the cost of energy. Because over the past few weeks, the renewed military conflict between the U.S. and Iran pushed Brent crude oil aggressively back toward the $100 a barrel threshold.
Yeah, and as of the episode date, prices have settled back down under $89 following a pause in the fighting. But that incredibly rapid, temporary spike exposed just how sensitive local economies are to these geopolitical choke points.
And the real-world impact of that spike is devastating at the household level. Look at Northern Ireland. Roughly two-thirds of households there rely specifically on home heating oil, which is the highest dependency rate in the UK.
Because they lack piped gas infrastructure in a lot of rural areas, so they are incredibly exposed to global crude volatility.
Right. And in just 3 weeks, the average cost of 500 liters of heating oil surged 29%. It jumped from about $460 to roughly $590. That is $130 just disappearing from a family budget in less than a month, simply because a shipping lane in the Middle East was threatened.
In volatility of that magnitude, it instantly paralyzes consumer spending. But the secondary effect is how it paralyzes financial institutions.
Because standard economic indicators basically become useless, right? Employment reports or consumer confidence surveys don't mean much when inflation can just spike overnight due to a missile strike.
Exactly. Investors are desperate for any indication of how the Federal Reserve is going to react to this sudden imported inflation. And that desperation is driving them to those highly unconventional, hyper-specific prediction markets we mentioned earlier.
Which brings us back to the dystopian part of today's market. Traders on this prediction platform called Kalshi are not just betting on the direction of interest rates. They are betting on the specific vocabulary that Fed Chair Kevin Warsh will use at his upcoming Wednesday press conference.
Yeah, the contracts currently show a 50% implied probability that he says the word shock and a 74% chance he says the word oil.
I mean, I have to push back on treating this as a serious financial indicator. Turning central bank communication into a literal casino game based on vocabulary, that sounds like a fringe crypto thing, not a metric of institutional Wall Street sentiment.
It's totally reasonable to view it with skepticism, but you have to look at why algorithmic trading firms are using them right now. The market is completely flying blind. Before this energy spike, the consensus was that the Fed would hold rates steady through the end of the year, maybe cut in 2027.
But the sudden surge in oil prices just completely upended those models.
Right. The odds of an immediate rate hike this week suddenly spiked to 38%. So institutional traders are using these vocabulary markets as a proxy to quantify the Fed's internal panic level.
Oh, so if Warsh says oil and shock, it signals to the market that the central bank views the Middle East conflict as a core domestic inflation threat, demanding an immediate monetary response, not just some foreign policy issue.
Exactly. It's the earliest possible indicator of a massive shift in the cost of capital.
Well, speaking of massive shifts in capital, while we wait to decipher what Kevin Warsh might say, you can find more of our analysis, plus brain candy and classic audiobooks at clarineratio.com. And that concept of capital expenditure actually connects perfectly to what is happening in the technology sector right now.
It really does. Because if the cost of borrowing money is going up, the sheer scale of investment required to fund the artificial intelligence revolution becomes incredibly precarious. We are watching the tech sector build this increasingly circular ecosystem to finance these projects.
And we are talking about sums of money that just defy normal economic gravity. The Wall Street Journal reported that NVIDIA is currently in discussions to provide a $250 billion backstop for OpenAI.
Yes, $250 billion. And it's structured so OpenAI can secure a lease for a proposed 10-gigawatt data center in Ohio, which is being built by SoftBank.
Okay, let's break down the mechanics of this arrangement because it's dizzying. NVIDIA makes the specialized chips required to train AI. OpenAI is their biggest customer, buying tens of thousands of those chips. But OpenAI also needs an unprecedented amount of physical infrastructure to house them, which is where the SoftBank data center comes in.
Right, so by guaranteeing $250 billion in debt, NVIDIA is using its highly profitable balance sheet to subsidize the infrastructure needs of the very company buying its products.
And this is on top of the $30 billion NVIDIA already invested directly into OpenAI earlier this year, right?
Exactly. It's a massive self-reinforcing loop.
It honestly sounds like the modern equivalent of a 19th century company town. You know, the factory owner pays the miners, but simultaneously lends them the money to buy groceries from the company-owned store, while also acting as the guarantor for the company-owned housing.
That is a perfect analogy. It generates spectacular revenue figures on paper, but the capital is just moving in a closed loop.
But at some point, doesn't an actual independent consumer have to step into this ecosystem? Like, someone has to buy enough software subscriptions to make a $250 billion data center lease actually viable.
And that is exactly what makes Wall Street intensely nervous right now.
Yeah.
The centralization of risk is huge. If the coal mine dries up in your company town analogy, the grocery store and the housing market collapse simultaneously because they are backed by the exact same capital.
So if OpenAI fails to monetize its models fast enough, or if that data center construction faces massive overruns, the liability cascades directly back onto NVIDIA. The entire AI supply chain is tethered to a single point of failure.
Which is why the easy money in the tech trade seems definitively over. Investors are looking at these massive circular debt loops and demanding actual earnings visibility. They are rotating away from companies burning cash on AI infrastructure.
And that rotation is creating a really surprising new dynamic regarding who is considered a safe haven, because right now, the ultimate defensive play in the tech sector is Apple.
Apple is currently the only top 10 stock in the S&P 500, trading near an all-time high. Options traders are buying heavy volume in Apple, pricing in a massive 4% implied move following their upcoming earnings report.
I saw there was $442 million tied to call options on a single Friday alone. So the biggest flex in Silicon Valley right now is actively choosing not to build a 10-gigawatt data center.
Basically, yeah. Investors are looking at Apple's massive cash reserves and their steady consumer hardware business, and they're treating them like a utility stock during a hurricane. Apple is being rewarded specifically because they are sitting out the circular debt game.
But while big tech is building these closed financial loops, the plumbing for retail investors is blowing the doors wide open. The structural barriers that used to separate institutional traders from everyday consumers are being completely dismantled.
Both domestically and internationally. Domestically, the CME Group just launched cash-settled single-stock futures for 55 U.S. equities.
And we are talking about highly volatile, heavily traded companies here: SpaceX, Micron, Tesla, Apple.
Right. And the mechanism here represents a major escalation in retail access. Traditionally, if an individual investor wanted leveraged exposure to a specific company outside of standard market hours, they were forced to use options contracts.
And options are notoriously complex. I mean, they suffer from time decay, meaning the contract loses value every single day just by existing.
Yeah, and they're highly sensitive to implied volatility. So you could correctly predict that stock will go up, but still lose money on an options trade if the timing or the volatility shifts against you.
But these new single stock futures remove all that complex math, right? They are purely directional. You are simply betting whether the price of the stock will go up or down.
Exactly. And they offer incredible access. These contracts allow retail investors to trade long or short, heavily leveraged on margin, nearly 24 hours a day, 5 days a week.
So, if a major geopolitical headline hits the wire on a Sunday night, or a CEO tweets something market moving at 3 in the morning, you no longer have to sit on your hands and wait for the opening bell in New York. You can immediately execute a leveraged position.
The retail market just never sleeps anymore. But, this unrestricted access introduces a phenomenal amount of margin risk directly into household portfolios.
Well, and we are seeing similar extremes in market architecture playing out abroad, just utilizing an entirely different mechanism to drive prices. Consider the recent debut of the Chinese memory chip maker CXMT on the star market in Shanghai,
The initial figures on that were just staggering. The stock surged 466% in its market debut.
which instantly valued the company at roughly $487 billion. It immediately became the most valuable listed company in mainland China.
And on the surface, it's incredibly easy to attribute that massive valuation to the global AI boom, plus Beijing's aggressive domestic push for technological self-reliance, especially since CXMT manufactures the DRAM chips that are essential for data centers.
But the underlying mechanism driving that 466% surge wasn't actually a reflection of enterprise value, was it? It was a structural quirk.
Right, it was something known as the free float. When CXMT went public, only 7% of their total shares were actually made available for public trading.
Wait, only 7%?
Yeah. The remaining 93% were locked up by insiders, state funds, and early investors.
A 7% float completely breaks the pricing mechanism. If you have overwhelming pent-up nationalistic and retail demand trying to invest in China's premier AI champion, but they are all fighting over a microscopically small pool of available shares. I mean, a violent price explosion upward is basically a mathematical certainty.
It creates a phantom half-trillion-dollar market cap. It is a supply and demand bottleneck engineered directly into the structure of the IPO. We are witnessing a broad decoupling of market price from traditional business fundamentals, driven entirely by how the financial pipes are laid.
Which raises a really uncomfortable question for anyone trying to navigate this. If retail traders in the US are using leveraged futures to trade off 3 a.m. headlines, and foreign markets are using tiny 7% free floats to engineer half-trillion-dollar valuations, does the structural architecture of the trade matter more than the actual underlying business?
It certainly seems that way. The rules of engagement are dictating the outcomes more forcefully than the actual participants right now.
Because the stories we have tracked today reveal a landscape where the mechanics, whether it's closing the de minimis loophole at the border, or circular corporate debt propping up data centers, or algorithmic vocabulary gambling, they are aggressively overriding traditional economic behavior.
Yeah, the mechanisms are the message.
And we found one final detail in the sources that just perfectly captures this financialization of everyday life. Ford Motor Company is attempting to boost their profit margins by launching special edition aftermarket customizations for their vehicles.
They're referring to them as vehicle drops, explicitly attempting to mirror the hype cycle of a limited edition sneaker release.
And these are not minor upgrades. We are looking at aesthetic packages and performance parts that run anywhere from $13,000 to $27,000.
But the really fascinating part is the mechanism they are using to sell these packages. Ford is allowing buyers to roll the entire cost of these aesthetic parts directly into their monthly car loans.
Just think about the economic reality of that transaction. You are taking out a 72-month auto loan, paying compound interest for 6 years to finance a custom paint job and a set of aftermarket rims.
The ability to hide a $27,000 aesthetic upgrade inside a long-term loan payment creates an entirely new, highly leveraged consumer behavior.
Exactly. If we are financializing the aesthetic of our cars on 6-year loans, right alongside $250 billion AI data centers and 24-hour leveraged futures, I mean, where does the financial engineering end and actual tangible economic value begin? It seems like the invisible spreadsheet running beneath our feet is only going to get more complex.
And understanding exactly how those mechanisms work is really the only way to navigate it.
It definitely is. Thanks for joining us for this look at the markets. We will see you next time.